Okay, this recording will cover bond issue. I'll do one at par, one at a premium, and one at a discount, and I'll show you what the interest payments look like for these three. So this is going to be based on example 15.2 in the textbook. The textbook has parts A, B, and C, and then I've added D and E, which are the issuance of a bond at a discount and a premium. So the bond is $500,000. It's got a 10% interest rate and it's a 10-year bond, and the interest is payable annually on January 1st. So in the first instance, the bond is going to be issued at face value, so that's at 100% of the face value. So on January 1st, 2017, the bond is being issued. So you're going to debit cash for the face value of the bond, which is $500,000, and you're crediting the bond payable. We're going to do an adjusting entry at December 31st for the value of the annual interest payment. So that would be $500,000 times the interest of 10%, giving us a payment of $50,000. Now, because this is at the fiscal year end, it's going to be interest payable. So at December 31st, you'll have interest expense of $50,000 in interest payable. Now, our interest payable date will be 1 year from the date of issue. So the interest payments will all happen on January 1st. So the annual interest payment date will be January 1, 2018. So on January 1, 2018 is when the cash will flow. So the interest payable gets a debit and the cash gets a credit for $50,000. Now, even when the bond is issued at a discount or a premium, the cash payment or the coupon will always be $50,000 because the bond is $500,000 at 10%. So the coupon will always be based on that $500,000 face value with a 10% rate of interest. So in D, when the bonds are issued at 97, so this is when they're issued at a discount, we're going to be multiplying the bond face amount times the 97%. That gives us a dollar amount of $485,000. So we receive cash of $485,000. The bond payable is recorded at $500,000, and the difference is the discount on bond payable. So when we record the interest amount at the end of the fiscal year, we have to amortize that bond discount over the life of the bond, and we're going to do that straight line. So we have to amortize the discount at $1,500 a year. So at December 31st, we're going to show the interest payable at $50,000, but we have to amortize the discount at $1,500. So the bond interest expense is going to be the combination of the $50,000 of interest payable and the $1,500 of the discount that's being amortized to give us interest expense of $51,500. This is why when a bond is issued at a discount, the cost of the bond is going to be higher than the cost when it's issued at par at face value. But when we make the payment, or the actual cash value or the cash we have to pay is still going to be $50,000 because the coupon is based on the face value of the bond and the interest rate that is stated on the bond, the 10%. So in this case, what's happening is the bond gets issued at a discount because the bond market is requiring a higher rate of interest than the stated rate of interest. So the bond pays 10%, but the market currently is demanding that the bonds of this level of risk pay a higher amount of interest than this bond is paying. So for letter E, the bond is being issued at 102, so it's giving you they're paying you more than the face value. So this bond is going to sell for $510,000. So that is going to be at a premium, and the bond issues at a premium when the bond is paying more than the market demands. So this bond is paying 10% interest and the market is demanding something less than 10% interest. So at the date of issue, we're going to receive $510,000 in cash. The bond payable is $500,000, so that's what we have to pay back in 10 years, and we have a premium, so we receive $10,000 more than we have to pay back. So the adjusting entry at the end of the fiscal period, we're going to amortize this $10,000 over 10 years. So $1,000 a year is going to go towards reducing the interest expense. So on December 31st, we have the interest payable, so that's the coupon amount, and we amortize this bond premium. So the interest expense only ends up being $49,000. So you can see, because we sold it at a premium, the cost of the financing or the cost of the bond is lower when it's sold at a premium than it is if it's sold at par. And again, the amount of the payment is the same regardless of whether it's sold at face, a discount, or a premium, because that is going to be based on the face value and the interest rate that are stated on the bond. This recording has an example of a retirement of bonds at maturity, an early retirement of bonds, and a conversion of bonds to stock. So this is based on exercise 15-5B. Stern Company has issued $4 million of bonds at par or face value, and those were issued on January 1st, 2017. So we're going to start with the journal entry to record the retirement of the bonds. Okay, so assume the bonds were issued at face. So when they were issued, we had a debit to cash and a credit to bonds payable. So if these bonds at maturity, when they are retired, you basically would flip that and we would be debiting bonds payable and crediting cash. So this is assuming that all of the interest payments are made. They didn't give you an interest rate here because it doesn't really matter. You just would be making the interest payments in full as they come due. So there would be an interest payment at the date of maturity. So if this were a 10% interest payment, you would have $400,000 of interest paid at the date of maturity. If it was paid annually, you'd have a $400,000 interest payment on 1/1/2018 and one every year until the bonds are due. So the date of maturity would be 1/1 of whatever year is appropriate. All right, so now we're going to record the retirement of the bonds early. So these would have to be callable bonds because you would have to be able to buy them back early. So in this case, we're calling the bonds and we're buying them at 98. So they were paying a discount for them. And when the bonds were originally issued, they were issued at a premium, and there's some of the premium that still has not been amortized. So when we go to do this transaction, we have to figure out what numbers to record. So the first thing we want to record is clearing off the bonds payable. So the bond payable we have to take off the books is the whole $4 million. And since it says the premium on the bonds is $18,000, we have to take off the premium as well. The amount we're going to be paying is the $4 million times the 98, because that's what we're paying to get the bonds back. So the cash outflow will be $3,920,000, and then we have to make this balance. So we've got $4,018,000 on the debit side, and we need to have $4,018,000 on the credit side. So in order for that to balance, we need $98,000 to get the credits to be $4,018,000. So that would give us a gain on retirement of $98,000. So this would be an early retirement of the bonds. So these would have been callable bonds, and we're buying them back off the open market before we hit the maturity date. And in this example, we are converting the bonds into stock. So the conversion is that we will take the $4 million of bonds and we're going to turn them into 120,000 shares of stock, and the stock has a par value of $10 per share. We're going to assume the bonds were issued at par. So we're going to have to debit $4 million of bonds, and we need to record 120,000 shares of stock. So the stock, you have to record it at a $10 par. So 120,000 shares at a $10 par is 1.2 million, and then we have to have the debits equal the credits. So your excess over par account has to be enough so that your credits equal $4 million. So this in total needs to be $4 million so that your credits are balanced with your debits. This recording covers example 15.8b. It's got an early retirement of bonds and a conversion. So 3 independent examples in this. So the first one, we have $130,000 face value bonds. They're 12% bonds. They were being retired on June 30th, 2017 at 103. So they're paying 103% to buy the bonds back at the time that they are, excuse me, sorry about that, had a big sneeze. Okay, so at the time that they're being retired, they had a carrying value of $117,500. So they were sold at a discount, and they are not at maturity date. So the bonds are paying annual interest on June 30th every year, and there is an interest payment due on June 30th, and the interest payment has been made. So first thing we have to do is take the bonds payable off the books, and the bonds are on the books at a discount because we see that the carrying value is 117, and that's lower than the face value of 130. So there's a discount on the books of 12,500. So the discount has to come off the books as well. Now we are retiring the bonds by paying 103%. So 103% means we're paying $133,900. So we're going to show cash going out at $133,900, and then this has to balance. So our credits here are 146,400. So our debits need to be 146,400. So we're going to have a loss on the retirement of 16,400 so that our debits are equal to our credits, and that's it. Okay, so the second example, we're retiring 150,000 face value bonds. They're 12.5% bonds, so they're paying 12.5% interest, and we're doing this on June 30th of 2017, and we're paying 97% of the face value to buy these bonds back. So these are callable bonds. The carrying value of the bonds at redemption is $151,000. So when these were originally purchased, they were purchased at a premium. The bonds are paying annual interest, and the interest payment was due on June 30th of 2017. So the interest was already paid and recorded. So on June 30th, the first thing we have to do is take the bonds off the books. So we're going to take off bonds payable of $151, and then there's going to be a $1,000 premium on the bonds that have to come off because they were had a carrying value of $151,000. Now we're going to have to take off what we paid for these. So we have $150,000 at 97%. So we paid cash of $145,500, and then we have to have the debits equal the credits. So the debits are $151,000, and we need our credits to be $151,000. So we need another credit of $5,500, and because that's a credit, it's going to be a gain on retirement. So now our debits are equal to our credits. So we're all done. Okay, Now, this third one, we have a conversion. So we have convertible bonds outstanding. That means we're going to change the bonds into stock. So we have $80,000 of bonds. They're 8% 12-year bonds. So the bonds were sold at face value. So there's no premium, there's no discount. They're paying interest on December 31st. They're convertible into 30 shares of $5 par common stock for every $1,000 of bonds. So on December 31st, after the interest has been paid, 30,000 face value of bonds are converted. And I think that what I did was $80,000 of the bonds being converted. So let's see. Yep. So I'm going to cheat and change this to 80,000 because I didn't read this fully. So we're going to say the problem says $80,000 of bonds. The market price of common stock is 44. So this is actually information that you don't need because we don't care what the market price is. So if $80,000 of the bonds are converted, we need to take the bonds off the books at 80,000 and we have to figure out how many shares of stock we need. So if every $1,000 worth of bonds is going to be turned into 30 shares of stock, we have to take 80,000 divided by 1,000. So we'll have 80 times 30, so 80,000, so it's 80 bonds times 30 shares per bond. That gives us 2,400 shares of stock, and it has a $5 par. So this is $12,000 worth of common stock. So we're going to do common stock $5 par, $12,000. And this, we have to have $80,000 here. So the rest of it's going to go into excess of par. Now, if this, I had read the problem correctly and we were only converting $30,000 of bonds, this would have been 30 times 30. So 30 times 30 would have been 9,000. So I would have had 900 shares of stock times 5. So that would be times 5 is 4,500. So this would have been 4,500. And this would have been 25,500. Okay, so that's if it had been $30,000 worth of bonds. And I think that's it.